Welcome, entrepreneurs! In today's session, we're going to explore a crucial aspect of tax savings: deductions for supplies and equipment. Whether you're just starting your business or you've been running it for years, understanding how to properly deduct the supplies and equipment you use daily can have a significant impact on your bottom line. We'll cover the types of supplies and equipment that are deductible, how depreciation works for larger purchases, the importance of record keeping, and strategies for maximizing these deductions. Let's dive in. Let's start by talking about the types of supplies and equipment that you, as a business owner, can deduct. Office supplies. These are the consumables that keep your business running smoothly on a day-to-day basis. Think paper, pens, printer ink, and other materials you use regularly in your operations. Even small expenses like these add up over time, so don't overlook them. Computers and software. If you've purchased computers, laptops, or software programs essential for your business, you can deduct those costs. These items are vital for many businesses, and they can represent significant savings when deducted properly. Furniture, desks, chairs, filing cabinets. If you've purchased furniture for your office, you can also deduct these items. Even creating a comfortable, productive work environment with the right furniture is considered a necessary business expense. Tools and equipment. For more specialized trades, tools or machinery necessary for your work, whether it's construction, manufacturing, or repair, can also be deducted. These could be welding equipment, saws, manufacturing machines, or any equipment specific to your industry. For smaller items like office supplies, you can typically deduct the full cost in the year of purchase. But for larger purchases, such as equipment or furniture, you may need to depreciate the asset over time. Depreciation allows you to spread the cost of an asset over its useful life, providing a tax deduction each year rather than all at once. There are two main methods of depreciation. Straight-line depreciation. With straight-line depreciation, the same deduction amount is spread evenly over the asset's useful life. For example, if you purchase a $10,000 machine with a useful life of 5 years, you'll deduct $2,000 per year for 5 years. Accelerated depreciation. This method allows you to take a larger deduction in the earlier years of the asset's life. This can be beneficial for improving cash flow, as you'll get a bigger deduction sooner rather than later. Understanding which depreciation method to use depends on your cash flow needs and long-term strategy. If you need bigger deductions early on, accelerated depreciation may be the right choice for you. Let's look at an example of how depreciation might work. Meet James, who runs a small landscaping business. Last year, James invested in a $15,000 commercial lawnmower for his business. Since this is a significant expense, he decides to use accelerated depreciation so he can get a larger deduction upfront. Instead of spreading the deduction evenly over the mower's expected 5-year life, he takes a $6,000 deduction in the first year and smaller deductions in the following years. This upfront deduction helps him reduce his taxable income and improve his cash flow, which is crucial for growing his business. In future years, James will continue to deduct the remaining value of the mower, but the biggest tax savings happen right when he needs it most. Next, let's talk about record keeping. To claim deductions for supplies and equipment, maintaining accurate and detailed records is critical. You'll need to keep receipts for every purchase, invoices for larger purchases or equipment, any warranties or documentation related to your equipment, records that show depreciation schedules, if applicable. Using accounting software to track and categorize your expenses can make this process easier, especially as your business grows. Not only will this help you at tax time, but it also gives you better insight into your business spending, helping you make smarter financial decisions. Now, let's discuss a few strategies to ensure you're getting the most out of your deductions for supplies and equipment. Plan your purchases. If you know your business needs a large piece of equipment or a significant amount of supplies, consider timing your purchases strategically. For example, making these purchases before the end of your financial year can allow you to deduct them in the current tax year, helping to lower your taxable income immediately. Take advantage of Section 179. This is a powerful tax tool for entrepreneurs. Section 179 allows you to deduct the full purchase price of qualifying equipment and software purchased or financed during the tax year, rather than depreciating them over time. There are limits to the amount you can deduct, but if you're making a significant investment in equipment, Section 179 can be a huge benefit. Combine personal and business use. If you use an item for both personal and business purposes, like a computer or tablet, you can only deduct the percentage of the time it's used for business. For instance, if you use a laptop 70% of the time for business and 30% for personal tasks, you can deduct 70% of the cost. Be sure to keep detailed records to support your claim. Let's look at another real-life example of how these strategies can be applied. Let's say Karen runs a small e-commerce business and has decided to upgrade her equipment by purchasing a new $7,000 inventory management system. Instead of depreciating the equipment over its 5-year life, Karen decides to take advantage of Section 179 and deduct the full $7,000 in the year of purchase. This provides her with immediate tax savings and helps her reinvest in other areas of her business. By utilizing Section 179, Karen's taxable income is reduced significantly in the year she made the purchase, and she benefits from faster tax savings. In conclusion, understanding how to deduct supplies and equipment properly can make a huge difference to your business's financial health. The key takeaways are: deduct your office supplies, computers, furniture, and tools that are necessary for your business. For larger purchases, familiarize yourself with depreciation methods to spread the cost over time. Maintain accurate records of every purchase, including receipts and invoices. Use strategies like Section 179 to maximize your deductions and improve your cash flow. Thank you for joining me today, and I hope this session has helped you better understand how to leverage deductions for supplies and equipment to your advantage.